So I'm here with Richard Woolf. Richard, you are a product manager for our business information area of Experian UK and I. And obviously alongside the many things that your role entails, your responsibility as well is to really understand what's going on in the market and kind of how them trends are changing. So that's what I just want to spend a few minutes today kind of talking to you about and getting your opinions on. So I think the first thing that we need to look at is, as of March, the United Kingdom went through a huge change. So we saw we saw ourselves locked down, and as a result, many businesses had to close their doors as well. Since then, obviously, we've emerged through lockdown, etc., and we're still seeing kind of a graduation of that. But how has the business landscape changed, and also kind of the commercial credit environment as well?
So I guess just looking at the data that we have within Experian, there's a couple of sure signs that something is going on and is a little bit wrong, even if you didn't know that we were in this massive lockdown situation. So probably two things that have been really key that we've noticed is that as soon as we hit lockdown, there seemed to actually be a significant drop in the number of businesses that were officially closing, so going through insolvency or winding up or dissolution. Now, this is kind of counterintuitive to what you'd expect in those times. Businesses would automatically start to close as they didn't have trade coming through their doors. However, because of some of the schemes that have been put in place, initially stopping insolvency proceedings, courts closing down, and then subsequently some of the funding that businesses have received from the government, whether that be through furlough schemes or some of the lending schemes like the bounce back loans or the coronavirus business interruption loans, these businesses have been able to survive through this period because of this, and also because of the changes in procedures. So at the moment, we probably haven't seen as many businesses close as we thought we would. That may be coming in the future, so it's something to watch out for. On the other side of the coin, we've actually seen over the last few months an uptick in businesses incorporating. So these are new businesses coming to the market, which again, would you really start to look to start a business during this time? Maybe not. But if people have been put on furlough, they have some time on their hands, they may be looking to branch out on their own. They might have a great idea and are starting up a new business. It might also be that it's filling a bit of a gap that we saw at the very beginning of lockdown with a slight dip in new incorporations. So those businesses that paused at the end of March and April before starting up are now starting up just a couple of months later. So that's why we're seeing that spike. There's potentially also a third reason, and this is something a bit more to watch out for, is businesses that have taken on too much debt are starting new businesses up to try to shift all of their trade and their assets to a new business and escape debt through what we call phoenixing at that point. So far we've seen trends that may be counterintuitive really, but certainly that there are reasons behind this, and I'm sure that it'll continue to change as we move through the next few months.
And obviously you've just mentioned there about the government schemes that have been put in place to obviously support businesses, and that's obviously been quite a huge help to many and still continues to be so. But in terms of kind of what does that demand look like? Is it your typical business who would be seeking credit wanting it, or are we finding there's kind of a new trend coming through? What's that kind of environment look like for demand on commercial credit today?
So it's kind of really interesting going back to the underlying data. We can see businesses start to struggle at the beginning of lockdown. They're paying their suppliers that little bit later than usual, which ordinarily you'd suggest they may need some help, they may need credit. We did, however, see a slight drop in the searches to our bureau, suggesting there wasn't that demand there. Whether this was because at the beginning of lockdown, lenders didn't know how they were going to operate during this period. So it wasn't necessarily a decrease in demand, it was that people weren't sure how to handle it, because everything we were hearing was these businesses needed credit, and some of the underlying data also suggested they were going to need some way to survive. So yes, the bounce back loans and the coronavirus business interruption loans were definitely something that was needed to come in, and we can see as soon as those schemes hit, spikes in credit applications and new loans going out. It's really significant numbers of those that we've seen within our database and has been widely reported. However, there are some signs amongst those loans that may not be looking as rosy. Obviously, the loans have been given out to businesses that need these, those that are struggling the most. That does mean that we've seen an increase in the number of businesses that we would have said were riskier receiving these loans than ordinarily would be able to get their would be able to access. So whether this further down the line means that these businesses may struggle to pay these loans back, it's something again that we need to look out for. Clearly, looking at the sectoral view of this, you can see that those businesses that are most likely to be hit, so those in the accommodations, food services industries, construction, have been able to access a higher proportion of these loans as well from what we're seeing. So it's good that the money is going to the right places within the economy as well. And we can see that from the underlying data we get coming in.
And as you say, there's lots of different trends that are coming through, some of which are in some respects delayed, as obviously these loans aren't yet to be paid. So potentially next year, when the payments are due, we could start to see kind of some of the real trends go through. Could they afford the loan that they were given, etc.? And that would be really interesting. But I think one of the things to really understand is from a lender perspective, what should they be monitoring in regards to understand and protect their portfolio?
Yeah, so there's a number of things that lenders can start to look at, and it's really important to get that full picture of an individual or a business that is borrowing by utilising external sources. So whilst lenders might be able to see performance on a loan that they have provided, they don't know how the business is operating outside of that. So looking at things like payment patterns to suppliers through things like payment performance schemes, to see whether they're paying to terms and tracking that, because certainly as businesses start to struggle, they start to pay their suppliers slower, and then it'll move on to defaulting on loans. So that's something to monitor. Also, for those businesses that are able to, looking at things like underlying credit account turnover information to see, have these businesses got enough money coming into the business on a monthly basis, and comparing that to the trends in terms of the money going out, to see again where those businesses are starting to struggle, their expenditure is going above and beyond the income that they're coming in, is another surefire sign to track. And then ultimately, just coming back to some of the more simplistic measures, tracking a business's commercial credit scores. So being able to see on a scored basis, these businesses potentially even performing really well and remaining stable, or them declining and those scores getting worse over time as they start to struggle and then potentially start to default on these loans.
And I think, yeah, that's been really helpful. And I think just a final thing is, obviously commercial credit and consumer credit has always been very interconnected. When you look at the trends coming through, obviously unemployment trends, etc., which Mohammed and the team have spoke about a lot through our kind of content series. In terms of kind of what that looks like in terms of unemployment levels, etc., are there any specific economic factors that are a real critical indicator that can help firms kind of understand and model scenario test on some of these areas?
So I think one of the things that you raised there was unemployment details. There's a lot of businesses that rely heavily on consumers for their income. So when individuals are struggling because they're becoming unemployed, or at the moment even when they're not sure whether they're going to be coming off furlough, etc., over the next few months, those individuals start to spend less money at these businesses, which can then have a knock-on effect. So being able to track things like unemployment across the country can help to have some early indications of certain regions or certain sectors that might be hit harder. You can then obviously start to look at trading between companies as well. And I mentioned there the payment performance details, but as businesses also struggle to pay their suppliers, if that's their source of income, then that's where they're going to be hit as well. So it's kind of looking at where those businesses are going to get the money from, and if that dries up, then obviously that business is going to be hit as well.
Well, Richard, that was, as always, really interesting. Thank you. So it'd be good to catch up again next month just to see if there's been any additional kind of movement and trends, etc. So thank you a lot for your time.
Thanks, Matt.